This is Michael Ogechi Abbey with Enterprise Express Tax Service. Welcome to the 2026 tax filing season. Of course, when we say 2026, we're really referencing 2025 taxes because we're doing taxes for the year prior. But Happy New Year, everyone. I haven't done a video in a while, and that's because there have been so many changes going on in tax world. But I thought it was necessary since we're already into the filing season and the IRS started processing on the 26th, which was this past Monday. All right. So we're already in full swing for the tax season, and I just wanted to make everyone aware of a few changes that they ought to be or should be aware of. All right. The one big, beautiful Bill Act is going to be the center of attention here because that's where all of this comes from. This was signed into law on July the 4th of 2025 and passed as Public Law 11921. And that's most of what we're going to talk about is centered on the one big, beautiful Bill Act. I'm not going to go into a lot of the too deep a dive in terms of details. I'm just going to go over the main things that I think will impact the generality of people. And then sometime later, I'll make other videos that will dig a bit deeper into other things. All right, let's get started with tax deductions. All right, tax deductions are what the government or the IRS gives you kind of like as a break, meaning that once those tax deductions either serve to reduce your tax liability or sometimes even give you a bigger refund. We call them your standard tax deductions. Well, the One Big Beautiful Bill Act has increased some of these deductions. For instance, if you are a couple that files jointly, your standard deduction has increased to $32,200. Okay, if you're a couple that files jointly. Um, if you are single, all right, you file single, then your standard deduction is now $16,100. And that also applies if you file married filing separately, meaning that if you are married but you file for tax reasons, you file separately and your spouse files separately, then your standard deduction is going to be $16,100. Okay. If you file as a head of household, all right, then your standard deduction is now $24,150. Now, bear in mind, there is a caveat here. The caveat is this: if you itemize on your tax return, meaning that if itemizations, we use a form called Schedule A to itemize. This includes things like your mortgages, money you give to Salvation Army, real estate taxes. That's kind of where you itemize. Now, if you do itemize, it is possible that you may be better off itemizing instead of taking the standard deductions. All right. So this is where you need the expertise and guidance of your tax professional, your CPA, your tax preparer to sort of guide you and tell you what's best to do in these situations. Okay. Um, Another thing that's coming up, which I think is going to be quite relevant, especially for those of us who do investments in, say, like cryptocurrency. There is a new form that the IRS now has. It's called the 1099-DA. For those of you who are familiar with 1099 forms, you may, have gotten 1099 forms if you did any contracting work, if you did any gig work like Uber, Lyft, all right. Typically, for those types of jobs or work, you get paid, or rather, you get issued a 1099 at the end of the tax year so that you can file your taxes using a Schedule C form, all right? So in this case, if you did any trading with cryptocurrency, so on and so forth, if you made a lot of money with cryptocurrency stocks, or say using Coinbase, for instance, then Coinbase is most likely going to issue you with a 1099-DA. The DA stands for digital assets. All right. DA stands for digital assets. What the IRS is really trying to do is sort of cover that gray line. For a long time, there's been a gray area where digital assets, digital profits, crypto trading has sort of been under the radar. And what they're trying to do now is make it a lot more open or transparent. And so by issuing a dedicated form called digital assets, that's the IRS's way of, sort of making sure that nothing is missed. All right. So it's called the DA, Digital Assets Form. If you see that in the mail coming from a company like Coinbase or any other um, crypto trading assets platform, then know that you do need to provide that to your tax professional so that they can properly file your taxes. All right, let's look at something else. 2026 tax brackets. So the tax brackets exist to show where you fall in terms of your earnings with regards how much you're being taxed. All right, so that's why tax brackets are revised on a yearly basis. Tax brackets for 2026 range from the 10% at the lower end to 37% at the higher end. All right. And the specific income thresholds depend on your filing status. For instance, if you're filing single, you may fall into a different tax bracket if you're filing jointly, even though you earn the same as the person filing single, you may probably will fall into a different tax bracket. I'll give you a quick example. Um, the 10% bracket applies to income of up to $12,400 for singles and $24,800 for those who are filing jointly. The highest rate of 37% applies to income over $640,600 for those who are single and $768 and $700 for those who are filing jointly. Um, this can get a bit more detailed and more complicated, but this sort of gives you a general guideline, right, of what tax brackets are, how they function, and how you fall into them. I always tell people when they ask me, they say, well, why am I being taxed so much? I refer them to the tax brackets and I say, well, you're filing jointly, or you are filing single, you earn X amount and you fall into the 27%, 28%, or 30%, as the case may be, tax bracket. So all you need to do is calculate based on your earnings, what are you being taxed percentage wise based on the tax bracket that you fall into. And that always will give you a very good idea of how much to expect to be taxed at the federal level. Okay, the state level has their own taxes, but most people pay attention to the federal level because that's that's the big one. Okay, all right. Let's look at something else. Those of you who work in restaurants and earn your money from tips, for instance, effective 2025 through 2028, employees and self-employed individuals may deduct qualified tips that they receive, which are identified as, customarily as regular tips, for instance, and are reported on a W-2 form, right? So, but if it comes via Form 1099, then the individual will use a Form 4137 to directly report the tip. So it gets a little confusing here, but let's see if we can clarify that a little bit. If you work in a restaurant and the bulk of your money comes from tips, which typically can be the case, all right, it is now deductible. Those tips are now a, something that you can um, uh, deduct because they're considered to be qualified in that sense. All right. Um, Qualified tips include voluntary cash or charge tips that are received from customers, which includes shared tips. All right. So typically in restaurants, a client or customer may give you a tip after serving them in cash. Sometimes they'll add the tip onto their card, or some restaurants, what they do is at the end of the day, they pool all the tips together and then they divvy it out amongst the workers. So, everywhere has their own way of doing it, but this is just to say that qualified tips can be deducted. Okay. All right. There's more to this. Then there is a caveat. For instance, the deduction phases out for taxpayers who have an adjusted gross income over $150,000 for single filers and over $300,000 for joint filers. So there's an income limit to which this tip deduction is, is effective. All right. So there's a lot more to this that in some cases, again, you would need to talk to your tax professional so they can walk you through this and to see how this impacts you. Generally, this should be for the better. All right. Tip income has always been a little bit controversial in terms of how it's taxed, but I think this is an attempt to make it better. Okay. All right. Let's see what else is which I think is important to um, talk about. Oh, okay. In all these cases, to qualify for any of these deductions, you have to have a social security number. Kind of makes sense, but they emphasize it here. Well, there's something else here that's come up, and a lot of questions have been raised about this, and that is that there's now no tax on overtime. This is a biggie because a lot of people do earn a lot of their income by doing overtime. At least I know that a lot of our clients, uh, earn more money by volunteering for overtime or by volunteered for overtime. So let's take a look at this and see how it works. Effective 2025 through 2028. By the way, the reason why it says 2025 through 2028 is that these tax provisions under the One Big Beautiful Act are set to expire in 2028. I don't know. Maybe it's going to be renewed at that time, but that's why there's this caveat there. So effective 2025 through 2028, individuals may deduct the portion of qualified overtime pay that exceeds their regular rate of pay. For example, the half portion of time and a half can be deducted. You can tell the language used here, you've got to be sort of careful because it does have a caveat and a certain qualification, meaning the portion of qualified overtime pay that exceeds the regular rate of pay. And in any case, it could be the half portion of time and a half. That's just an example. All right. The overtime must be reported on Form W-2, Form 1099. Okay. And the maximum annual deduction is $12,500 if you're single and $25,000 if you are a joint filer. This deduction, or rather this, no tax on overtime, it phases out for taxpayers who have an adjusted gross income over $150,000 if you're single and over $300,000 if you are a joint filer, meaning that if you're someone who files with your spouse, your partner as married filing joint. Okay, so again, yes, there is a new tax deduction on overtime, meaning no tax on overtime, but there are certain qualifiers. And so again, what I would ask you to do is talk to your tax preparer or your tax consultant and have them walk you through and explain exactly how this impacts you, especially if you're someone who does a lot of overtime. Mhm. Um, let's now talk about something else that we've gotten quite a number of questions again, and that is no tax on car loan interest paid through the tax year. Okay, so this again is a biggie because a lot of people have, fairly sizable car loans and paying fairly sizable car loan interest rates. We all know the interest rates have gone up the last couple of years. And so this might be something that could help a lot of people out. But let's see what the actual qualification is. All right, so effective 2025 through 2028, individuals may deduct interest paid on a loan that's used to purchase a qualified vehicle for personal use that meets other eligibility criteria. Lease payments do not qualify. So if you have a car that's on a lease, that does not qualify. The maximum annual deduction is $10,000. So you cannot deduct more than $10,000 in this case. It phases out for taxpayers who have a modified adjusted gross income over $100,000 if you're single and over $200,000 if you are a joint filer. All right. Now, one thing that stands out here reading this is that you may deduct interest paid on a loan that's used to purchase a qualified vehicle. Okay, so it has to be a certain type of vehicle, all right, for personal use. Okay, not for business use, but for personal use, all right. Let's dig a little deeper into what qualifies or what counts as a qualified interest. The interest must be paid on a loan that does the following. The loan must have originated after December 31st, 2024. So if it's before that time, it doesn't qualify. It must have been used to purchase a vehicle that's used by the taxpayer, not by somebody else. So in other words, this vehicle should be in your name, and title should be in your name. The loan must have been secured by a lien on the vehicle, and it must be for personal use. In other words, a non-business vehicle. All right. Something else that's important here that I think we need to underline as well. If the qualifying vehicle loan is later refinanced, and interest paid on the refinanced amount is generally also eligible for the deduction. So refinancing the car will not disqualify you from the deduction. Okay. What counts as a qualified car? Well, it could be a car, could be a minivan, an SUV, a pickup truck, or even a motorcycle that has a gross vehicle rating or weight rating of less than 14,000 pounds. And it must have undergone final assembly in the United States. That's a big one because a lot of cars these days, some cars, not all cars are made in the United States. So it must have undergone final assembly in the United States. So there's a lot of things here that they threw in that make it, you really need to, do some research. Some cars these days are, the assembly starts outside the US and then it's finalized in the United States. All right, but you kind of need to figure out and find out whether your vehicle qualifies or is in this category. Okay. To verify final assembly, you can do a number of things. You can check the vehicle label at the dealership. You can check the vehicle VIN number. And you can also go to the National Highway Traffic Safety Administration, NHTSA. It's got something there called a VIN decoder that will verify vehicle assembly location. Who qualifies? It's available to both itemizing and non-itemizing taxpayers. So whether you itemize or you do not itemize, you can still claim this interest deduction. You must include the VIN number on your return for any year that you're claiming that deduction. Um, all right, another big one, and this is one that I think is really important, and it's probably the one that we're going to end this tutorial with, is one about third-party network transactions using Zelle, Cash App, Venmo, and the sort. There have been rumors over the last couple of years that any transactions using Zelle, Venmo, and even Cash App were going to be taxed. I can say that the government did have a plan to do that. They sort of put it on ice for a while because they wanted to sort of figure things out. Many people use these third-party transactions, but a lot of people use them for personal use. You might be sending a Zelle to your child who's away in school, or sending a Zelle to a sister or mother or a friend. Okay, so it does not always fall into a business category that is taxable. And so I think what they've done is they've tried to bring some clarity to this. So here are some changes. Um, there have been proposed regulations to explain when backup withholding applies to certain payments made through third-party payment platforms like Zelle, Venmo, and Cash App. Okay, these are the rules. For sellers and payees who receive payments through these platforms, the following will apply. All right. So under the new law, backup withholding generally will only apply when both of the following are true in any calendar year. The total payments to a person are more than 20,000. So if you're paying someone more than 20,000 through any of these third-party platforms, then there may be backup withholding. In other words, it might be taxable. All right. If the total number of transactions is more than 200, then very, very possibly there will be backup withholding. In other words, it will be taxable. Okay. And so this replaces the lowest. There used to be a $600 threshold that was scheduled under the prior law. This is a big change. This means that, pretty much for the average person, we can use these third-party, portals to send money and do things based on the fact that it will be considered personal business and not, major business. All right. Um, what does this mean for sellers? Well, as a seller, if you receive payments through a third-party platform and you do not exceed any of these limits, your payments will generally not trigger backup withholding under these proposed rules. This change may reduce withholding for individuals and small businesses with lower payment volumes. All right. So the advice to third-party platforms, or what they're required to do, is to track both the number of transactions and the total dollar amount that's paid to each payee, and to apply backup withholding only after both thresholds are exceeded. So I hope this has given a fairly, decent overview of the changes that have been brought about by the One Big Beautiful Bill. This is not an exhaustive, deep dive into the changes, because there's so, as if you know anything about taxes can get very detailed. But what this serves to do is just give you an idea of what to look out for, what to discuss with your CPA or your tax preparer, and hopefully this again will give you, the taxpayer, more information, and so that you're not taken by surprise when you see certain things on your tax form. It all pays to be as well educated as possible. Once again, my name is Michael Ogechi Abbey with Enterprise Express Tax Service, and I hope I've been able to provide you with some useful information. My email is there, and if you have any other questions about taxes, please let me know. Thanks, and have a great tax season. Bye.